Hi everyone, today we are going to discuss the quarterly performance of HDFC Limited. HDFC, the largest housing finance company in the country, reported yet another quarter of a good performance. Its net profit increased by 25% on a year-on-year basis. This was mainly aided by a strong loan book growth and stable margins. So let's look at the key highlights of HDFC's Q2 performance. Loan book growth and margins are the two key monitorable for HDFC, and it never disappoints on both the fronts. Despite its large size, HDFC continues to grow its mortgage book much faster than the industry. Its lending book stood at around 3,79,000 crore as at end September, which is a growth of almost 17% on a year-on-year basis. If we add back the loans which were sold in the preceding 12 months, the growth was even better at 22% YOY basis. Individual loan book growth was robust at 25% on a year-on-year basis and now constitutes around 70% of the total loan book. Non-individual loan book growth was at 13% on a year-on-year basis. Company and the management continues to focus on economically weaker section and low-income group in affordable housing segment. There was a strong traction visible in this segment as well in Q2. So on talking about the margins, HDFC reported stable spreads of 2.28% in Q2. Now, this demonstrates company's ability to maintain margins irrespective of interest rate cycle and amidst rising competition. Now, this is thanks to its strong brand and also to its superior funding profile. As we all know that HDFC's funding profile is very well diversified. For instance, it could manage to raise masala bonds to the tune of rupees 9,600 crore. Also, it has a huge public deposit base which is now nearing 1 lakh crore and is a key source of its competitive advantage. And the last and the most important point for HDFC is its impeccable asset quality. With the gross non-performing asset at around 1.18%, it continues to be superior as compared to other housing finance companies. Most importantly, we would like to highlight that management follows a policy of utilizing one-off gains to create excess provisions. In Q2 also, it utilized the one-off gains from stake sale in HDFC Asset Management to create excess provision, and which is very, very positive. So what's the outlook for HDFC? HDFC's performance, that is superior performance, is not just limited to its mortgage business. Some of its key subsidiaries, which includes HDFC Bank, HDFC Asset Management, HDFC Standard Life Insurance as well as Group Finance, have an equally good track record. Associates and subsidiaries contributed around 33% to its FY18 profits. With increasing scale and profitability, the subsidiaries now contribute more than 50% to HDFC's valuation. The stock has corrected more than 15% from its 52-week high following liquidity concerns. However, we know that HDFC is very well placed in a current funding environment. While its headline valuation seems little stretched, its core mortgage book is trading at around 1.4 times FY20. Now, this is a very compelling valuation and it's much below its historical average. It is a rarity to find a high-quality business at such a compelling valuation. Markets are staring at multiple headwinds in the near term, so investors should build a portfolio which consists of high-quality businesses with predictable earnings growth, and HDFC should form a part of any such portfolio. We recommend investors to buy HDFC. That's it from my side. For more research and stock updates, log on to moneycontrol.com.